Boom! Just like that, we are live. Happy Friday, everyone. Welcome back to another episode of Benzinga Live. Wish the markets were a little hotter to start the day. I told you all yesterday how I was playing the CPI. I was obviously wrong. I was hoping for a lower CPI. We instead got a higher than expected CPI. Inflation at its highest point, coming in at 8.6% in May, the highest at any point, going back to 1981. So it's 41 years ago. So we'll talk a little bit more about the inflation numbers, what exactly was causing that to jump higher than expected, and kind of the implication that has on stocks across the board. We'll be having Tim Quast on in about 45 minutes to talk about some supply and demand and market sentiment overall. So Tim Quast from MarketStructureEdge is really a great guy to get on a day like today, where we can really hone in and look at exactly what does the supply and demand look like there. Let me go ahead and get my Benzinga Pro screen shared up. We can go through some tickers from the chat. So let me know what you guys are watching. Let me know what you guys are trading today. I know what I've been looking at, mostly just the SPY and the Qs and the overall market today. But obviously we'll talk about some DocuSign. We will talk about Redbox and the chicken soup for the soul merger. Redbox has emerged as kind of this Reddit meme stock, so we will talk about Redbox, see what's going on there. All right, y'all, let's go ahead and play that intro, and then we will get this show started. Go ahead and smash the like if you have not already. Give us a subscribe if you're not already, and here we go.
This is Benzinga Live with Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. All right, y'all. So here is the SPY chart I'm looking at right now. We're looking at the daily right here. You can see we've had these just 3 red candles in a row that have brought us down, basically back to our lows that we were hitting late May at this 390 level. If we zoom out on the daily chart, I'm really interested in this kind of 350 level down here. If you look at where we were pre-COVID, 340, I don't think we're going to get all the way down there. But if we keep this negative momentum on the SPY, I do think this kind of 350 level is one that a lot of traders and investors are targeting. That would be about, so we're at 390 right now. So if you took off 10% from where we were at right now, that'd be $39. That would bring us right down to 351. So I think another 10% drawdown in the SPY is, definitely possible right now. It's obviously not a sure thing. Otherwise, I'd be backing up the truck and buying SPY puts for the next 10%. But I think even if we do get some more relief rallies, that if we can't clear this level right here, kind of that 420 level, then that negative momentum will continue, and we'll just continue to see smaller bounces that are part of a bigger downtrend. To me, again, if we do drop another 10% on the SPY and we're at that 350 level, I'm a buyer there all day long at the Qs we can look at individual stocks, right? And if Apple falls another 10% from here, that'd be about $14, bring it down to like 123, 122. Looking back at the chart, that would bring us right back to where we were at kind of June 2021. And again, even if I buy down here and then Apple continues to drop a little bit more, to me, that's fine. I can handle that because I'm going to be buying for the long term here. Now, let's talk about more in terms of the short term movement. So let's go to a 2-minute chart here. We can zoom in a lot and see. You can see right here, this is when we got that CPI print that came in higher than expected, dropped about a full % on the SPY, and then we opened down here. This is 930. This is the open. Continue moving lower. We dropped another %. It does look like that in the last 10 minutes or so, we got some buying down here, some little bounce, but I don't think it's really anything significant. I think, definitely now we've established these lows of the day. Looks like we dropped down to below 390, 389. So I'll just be watching SPY to see if we clear those lows again. And then I would expect some more. I would expect some continued selling if we clear that low of the day. But I don't think a bounce here from this point, from the SPY down like 2.7%, is it would be unheard of. I wouldn't be surprised if we end up closing the day down, say 1.5% or something. So we get a little bit of a bounce here. I would not be surprised. And it's one of those things where we've talked about it before on the show. Just the market does not like uncertainty. The market does not like not knowing things. So now at least that we know that inflation is higher than expected, that means, of course, that the Fed then has more reason to continue its rate hikes or even hike rates even further than the Fed is planning on it. So definitely, now that we have that certainty, you're seeing how the market is playing that out, how it is digesting it. Certainly a lot of algo trading going on today. Usually Fridays are just a little bit lower in terms of volume, especially a summer Friday. People are kind of on vacation. Let's check in on Netflix. I see Faults in the chat talking about it. Man, all right, let's go out to a daily so we can get a better idea of kind of just what's going on with this chart from a macro perspective. So Netflix, we had this double top back up here last fall in November 2021. This was kind of when we were at all-time highs, not just in Netflix, but in the market. The stock was trading at, what are we looking at here? $700. We hit a high of exactly on this day, November 17th, 2021. We've obviously come a long way down from there. This is just where growth was coming out of favor. People were selling off their high growth stocks. And then you had 2 consecutive bad earnings reports. You can see that here in January. And then here again in April. So Netflix has effectively, let's do some quick math here. Netflix. So in about from its November's levels to now, we're down more than 70% on Netflix. I get it. I actually bought some Netflix, like, I don't know. I want to say like here, like 3 feet, I was like, oh, this is a good deal. It's trading at Netflix, it will, if it keeps going down, eventually become an attractive investment. I don't know if that time is now. I mean, we can look at some of the numbers. Forward PE 17, that's very reasonable. Price to sales under 3, again, pretty reasonable. Might not be cheap compared to the cheapest stocks on the market, but compared to other high growth tech stocks, sure. The problem is that Netflix has basically confirmed in its last 2 earnings report that it's not growing. And it's not growing at the rate that it had been growing at. And people want to buy growth stocks for that growth. They're willing to pay a higher premium for, that growth. Oh, Patrick, you got your swag? I'm glad to hear it. I do got to do another swag shipment today. So if you're out there and you need some swag, you've been owed some swag and you haven't gotten it yet, drop a comment in the chat and we'll get you figured out. Either way, like I said, eventually this becomes an interesting investment. Eventually the stock price becomes so cheap that it doesn't match what the valuation should be. And then you got to expect, okay, Netflix will find some way to innovate and continue to grow. I think a lot of investors are just questioning what that will be. The streaming industry as a whole, whether you're looking at Disney Plus, Hulu, Netflix, Paramount Plus, Apple TV, has not been as hot as it was during COVID. That's expected, right? People were locked down. They didn't have anything to do. So what they were going to do, they were going to buy new subscription streaming services to be able to watch their shows and movies at home. Times are changing. People are traveling more. People are get out and doing more things. I personally actually just was going through some of the things I was paying for and canceled. I was like, I don't ever really use my Disney Plus. Canceled that. Canceled my Netflix. Look, I mean, this is on my radar. I'll be more interested in Netflix if it continues dropping. I think around like the 170, 165 level, I'm very interested at. But we'll continue watching Netflix to see if we can get any sort of bounce there. Let's go back to the Qs. Let's go to the 2-minute on the Qs. I mean, just nothing really. The problem is like we're not getting any big bounces. All positive price action is just getting wiped out by the next red candle. So I would like to see here, again, we're at the 2-minute chart. Let's go to a 10-minute chart. I would like to see at least if I see 2 consecutive green 10-minute candles on the Qs, that will be a sign to me that, okay, today we might be getting a little bit of bounce. And I can try to play that short-term daily bounce without getting overexposed in part of this downtrend. Because that's the bottom line, is it's attractive to buy these stocks while they're down, to buy the ETFs while they're down. But more times than not, if you're buying stocks in downtrends, you're going to get beat. All right, guys, let's talk real quick about DocuSign. So DocuSign reported earnings and not very great, not terrible though. We go to Benzinga Pro and look at the actual earnings. The EPS missed by about 8 cents. So the estimate was 46 cents, came in at 38. So the EPS, not great. Sales, 600 to 604 million versus 601 million estimate, not too terrible. But again, this is what happens when you are a growth company that is not growing anymore, right? You become, because then people don't want to buy you for the growth. All right, let's look at the income statement. So, yeah, I mean, you can see, so this doesn't have the most recent one on here yet. But yeah, I mean, you can just see for a while the growth was there, and now it's not. And DocuSign has come from highs of back in September 2021 of over $311 down to $66. So to put that into perspective, DocuSign has drawn down, let's see, some 78%. So if you bought DocuSign in September 2021, you are now down 78%. I'm curious to see. So I'm on kathysark.com, which shows. Okay, I think Kathy mostly got out of DocuSign. I know Kathy was in DocuSign for a while. She's still in Teladoc. Tesla is still her biggest share. Here, let me just share the screen. So this website is kathysark.com. It combines all of Kathy's ETFs to show you all 140 ARK ETF Invest ETF holdings. So this is all the holdings across the different ARK ETFs. Tesla is still your biggest position, weight almost 6.5%. Then Zoom, Roku, UiPath, Intellia Therapeutics, NTLA, which, I mean, I don't even know, like, I couldn't even tell you what this company does, but ARK owns 20% of it. ARK owns over 3% of Zoom. ARK owns over 10% of Teladoc, over 10% of CRISPR, just under 5% of Coinbase, Twilio, Shopify. She owns over 5% of DraftKings, 3% of Robinhood, a lot of Roblox. So a lot of these stocks have just not been in favor at all over the past few months. We can check out what ARK is doing today. I will guess it's down. Yep, it's down 7%. Let's see where ARK is at from its all-time highs of February 2021, down 74%. So ARK is now well below where it was trading pre-COVID. So before the COVID crash took the market down, ARK was trading at $58 a share. It's currently at $40. Now, this is an opportunity where if you believe in Kathy's, investment strategy, if you believe that long-term she has the best portfolio allocated for long-term growth over the next 5-10 years, here's an opportunity to buy. Myself, I'm not going out there and buying Kathy Wood or buying ARK right now, because I still think that if I'm looking at the different stocks out there, and if we are going to see a bigger downturn, if we're going to see the SPY drop another 10%, then I don't want exposure, to Tesla, because Tesla is still trading at, Tesla is still trading at a forward PE of 60, a price to sales of more than 13. So by basically all metrics, Tesla is still expensive. So if we're going to see a bigger downturn in the SPY, then in my opinion, the more expensive stocks are going to get hit first. Coinbase. Coinbase is interesting because if you're looking at the pure valuations, it looks very cheap, right? An under 2 price to sales, a very low PE. But when you're looking at these numbers, you have to understand how these numbers are calculated, and they're based off of the company's last earnings and how much revenue Coinbase was taking in over. So if we go over here to the financials tab, we go to the income statement, we can look at total revenue, over $1 billion, over $2.5 billion. So this is the past 4 quarters. So this is the quarter ending March 31, 2021, 1.8 bill. The quarter after that, 2.2 bill. All right, that's good growth. And now you go considerably lower than what you had 2 quarters ago, 1.3 bill. So it's lower than it was 2 quarters prior. And then it jumps up to the highest 2.5, and then back lower to even before that one. So that shows the cyclical nature of when the crypto market's doing well, Coinbase making some good money. When the crypto market's not doing well, Coinbase has some bad quarters. So the Coinbase's PE and everything is based off of these numbers that are coming in at 2.5 bill. So when I'm looking at what crypto's doing right now, and you can look at the trading volume and seeing how many people are buying and selling Bitcoin, it'd be laughable to think that Coinbase is going to put numbers out like this quarter right here. When Bitcoin, this is the quarter, that includes November 2021 when Bitcoin was at 65,000. And you can just look at the numbers of crypto and see that when Bitcoin's up, more people are trading it, more people are buying and selling it. So to me, I think it's safe to assume that Coinbase's next report comes in even lower than this. And then at that point, you're talking about a PE that's based off numbers of that the company's not even doing anymore. So I wouldn't want exposure here to Tesla, to Coinbase. And now that can flip on a dime if growth comes back in favor, if there's less fears about interest rate hikes, then growth becomes more favorable. And look, while I'm talking about Coinbase, it's making a nice move. We're looking at 2-minute candles here. You can see that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Out of the last 40 minutes, the majority of these candles have been green. Let's check in on the SPY, see what the SPY's doing. Ooh. That's what I like to see. 1, 2, 3, 4. That's 4 green candles in a row on the 2-minute chart. So at least for the last 8 minutes, SPY's been doing well. Let's see if that lasts. Right? What did I say? I said I wanted at least 2 green candles. All right, I'm not going to count this one because it seems pretty much flat candle. If we get another green candle like this on the 10-minute, that'll look nice, right? That'll show some buyers are coming in. If you're a day trader, don't buy ARK. Yeah, I mean, I agree, Brian. I wouldn't even mind buying ARK here if you're planning on holding it for 5-10 years. I'm talking about in the short term. I was saying earlier, I wouldn't be surprised to see the S&P draw down another 10%. And I think just if that happens, the Teslas, your Rokus, will not be doing that well relatively. So we'll see. I mean, you always, anytime there's this much fear around a name like there is around ARK, it is a buying opportunity. It's an opportunity for someone to come in and be greedy when others are fearful and say, oh, you guys don't want to touch this? All right, well, I will. And that's kind of where I was at with Baba for a while. I mean, Baba, no one has wanted to touch it for a very long time. Look, October 2020, we're trading at $315, right? There's been a lot of things that have happened since then from a macro standpoint, whether you're talking about supply chain issues, whether you're talking about inflation, whether you're talking about the war in Russia and Ukraine, China cracking down on kind of some big tech regulations. And the stock has just been a bloodbath from 310 all the way down to below 80, and we've since come back and are now at around 105, 108 bucks a share. But no one really wants to touch this. I don't think institution or retail. And I'm under the opinion that I think that China, isn't really that dumb. They know what they want to do in terms of trying to overtake the U.S. and becoming the world's biggest economy. They're not going to be able to do that by cracking down on their companies forever. So I think I'm betting on kind of long-term that the U.S.-China relations to remain largely unchanged, for China's economy to continue to grow. I'm not out here buying a bunch of Baba. I have a few shares in my Roth that I bought at around, I want to say I think I bought it when it was trading in this range right here. So probably the mid 120s. So I was way underwater on it for a while when it dropped down to 75. But like I said, it's 3 shares. So yeah, I think I bought it at 125. So my cost basis on it is $375. So it's just one of those things with Baba that it's, to me, it's drawn down more because of the fear around it with investors than it is because of any actual business problems or anything like that. Let's go back to the SPY real quick, see if we are giving up any of those gains or if we're trading pretty well still. All right, we're on the 2-minute chart here, 2-minute candies. All right, let's see if we can clear this 3 391.5 level, get back up to 392 potentially. What else did we need to talk about? Oh, we need to talk about Redbox. So Redbox announced the other day that it was being acquired by, holy cow, this thing is up 44% now. Who's doing this, guys? Who's out here pumping this on Reddit? I know this has got to be Reddit related, right? Let's go to the news tab. I'm just curious, what was the buyout price announced on this chicken soup for the soul merger? Let me see if we can find this real quick. Redbox chicken soup for the soul merger. Let's go to TechCrunch. Crackle owner, chicken soup for the soul entertainment and ad-supported video on demand. The operator for $375 million, comprised $50 million in stock. Are they going to go to share price? No. No. All right, back to pro we go. I mean, guys, look at this chart. So let's look at the daily chart here. This was a $2.50 stock May 16th. Now it is above $13. Why is it moving? Redbox Entertainment shares are trading higher on above average volume as the stock trends across social media platforms. Okay, so the Redbox buyout, Jay Rice is saying, is 60 cents and this thing is trading at $13. Make it make sense to me, people. If I see more of this, if I see more of some random shitty company up 40%, that's just going to make me think the Fed needs to rate hikes even higher. To me, the Fed needs to rate hikes until this shit isn't happening anymore, right? Because obviously there's some excess money out there going around playing, people are just using this as a speculative trading asset, making bets on it. And that doesn't happen, when rates are high enough to where people don't want to take that speculation on. I'm kind of kidding around. I don't really think this has any implication on like where rates should be at, but still, I mean, come on, guys. Up 40% today. Redbox, a stock that's getting bought out at 60 cents a share. What even is the chicken soup for the soul stock? Ticker CSSE. Down. Yeah, I don't know, guys. Make it make sense to me. People are buying stocks that are not correlated to the market. Yeah, and we saw that a lot during the GameStop AMC kind of craze. Like days where like GameStop was up like 20%. Oftentimes it was acting as a counter-cyclical asset. It was up while other things were down. What did sorry, Jay, what did Julian say? I know he's good. He was like one of the first SPAC experts when SPACs became a thing, and then now I feel like he's trying to like kind of brand himself away from SPACs now. I think for a while, if you looked on his Twitter profile, it was like the SPAC king, and now he doesn't have SPAC on there at all. Yeah, Patrick, I agree. I think anytime you see like everyone and their mama be bearish, that's an opportunity to be bullish. That it's good a lot of times to kind of be that contrarian, because if literally everyone is saying the market's going to go down, then I don't know. For a lot of times it doesn't. All right, Jay Rice is saying check out his Twitter. Let's go to Twitter. Julian. Redbox stock is trading at $10 while the CSSE merger consideration is just worth. Does anyone understand why Redbox is trading at a 15,000% premium? Probably the strangest thing I've ever seen in mergers and acquisition. This is the stock equivalent to owning libs, just squeezing shorts for the sake of it. Did you watch SPRT? Same thing. Anyone shorting who can remain liquid, but hedging. Yeah, I mean, this is like actually interesting because it does kind of make sense to me, right? Because you have all these people like quote unquote smart money who see that the stock is trading well $10 above the price that it's supposed to be bought out at. So the smart thing to do is buy puts. But then on the other side, you have people seeing that people are buying these puts and knowing that, okay, if there are enough people that buy that buy the stock to keep it elevated, the people that buy the puts are eventually going to have to cover it. And so people, it's just that it's like a compounding effect of more and more people as the price going up says, okay, this is the most obvious short ever. This stock is literally getting bought out once the deal goes through at 60 cents. Well, now it's trading at 14 bucks. So people are going to see that and just continue to buy puts on it, bet it for it to drop down and normalize to that price where it should be trading at. But then that's going to encourage more people to come in and say, oh, we got to buy this stock because of all the people shorting it. So it makes sense when you think about it like that, but then it just it puts you in it's like a prisoner's dilemma. Like, what side do you want to be on? It's game theory. What side do you want to be on? Do you want to be on the side that's betting against this and potentially getting stuck in a short squeeze? Or do you want to be on the side that's going to buy this up here at 14 bucks and then hope that more people continue to short it, which is going to encourage more people to come in and buy it, and then those shorts to cover, making it squeeze from 14 to 20 and then from 20 to 25. Who knows? The way I'm playing it is by not playing it at all. I'm not going to touch this. I think, unless you're just willing to bet that the stock is, if I had to bet, I would bet that this is going to go down, but I'm not going to touch it right now. I mean, see, to me, it stacks like that's not a sound strategy here with Redbox. I'm not going to buy Redbox and hope for its long-term potential. Does Redbox have a business model outside of its actual Redbox machines, which used to be a cool thing maybe in like the year 2000, but I haven't really seen or heard of anyone using? I could buy, if I got a movie from a Redbox right now, I wouldn't even know how to play. No, that's not true because I could put it in my PS4. But I think most people wouldn't have a way to play that video or to play that DVD. I don't think people have DVD players anymore. Let's go back to SPY. I think we're giving up some of the, yeah, I wouldn't get caught in any of these rallies, guys. To me, any of these rips are just an opportunity to sell, unless we can clear some of these levels. If we clear this 392 level, then I'd be looking to fill this gap back up to 393. But right now, nothing's looking great out there to me. I mean, let's go check back in on Tesla. Tesla now down more than 4%. ARKK still down more than 7%. Qs are down 3.4%. Wow. I mean, this is just a tough market. I don't know if you guys were on with us on Tuesday with David Green, but David Green's been trading for 30 plus years and has never said he said he's never seen a tougher market to trade. Which is hard to believe, right? That in 30 years, this is the toughest market. But, I hope you guys, let me know in the chat what you guys are doing. Like, are you guys more cash than you are? Are you guys more cash than you typically are? Yeah, Kyler, I've made money on those Tesla puts. I think I sold them yesterday with Nick on the show. Let's see what I did. I sold the Tesla 695 put for 630. Let's see what it's trading at today. And this is what I knew this was potentially going to be. I can't even, my Robinhood won't even show me the ones that expired today, so I can't really look at it. I knew that was going to potentially be what happened, Kyler, was that I was going to sell them and then I was going to be kind of upset that, if I would have held on to them longer, I would have been made more money. But you can't be mad about taking profits, about booking profits in this market. You really cannot. Getting greedy is just like the easiest way to ensure that you will not be doing well. Cash in USDC lending, Lord Byron says. Someone saying Redbox had its run, don't chance it. Yeah, I mean, the USDC 10% interest here is so attractive as an investment because, like, You can look anywhere. You can look at bonds. You can look at equities. You can look at cash, and nothing's getting you 10% besides USDC. So as long as that keeps going, you know, I would not feel safe. Say I had $10,000 as my nest egg right now, I would not feel safe putting all 10 grand of that into USDC for 10%. I'll just say that much. Just because, I mean, I've seen what happened with Terra Luna. So the problem with I bonds is you can only buy $10,000 worth. So if you buy as much I bonds as you can, let's see, I bond limit, $10 each calendar year. So, and if you buy I bonds now and inflation like goes down, you're actually losing money. So I bonds suck in my opinion too, Brian. So I don't know. I mean, USDC, like I said, is very interesting right now, that 10%, but if I wouldn't put my whole retirement in it, because then you're risking something like what happened with Terra happening, and then you're down in money that you could potentially need. So to me, I mean, I think any investment, oh God, 30's tripling down on SQ. Oh boy. Brian Shannon, who we're going to have back on the show soon, would be yelling at you right now. His biggest thing is do not buy stocks in downtrends, and this thing is in a hefty downtrend. The problem with Square is I think it's very, very much dependent. They've made more and more moves as a company to get more and more exposed to crypto over the past few years. So it's just like, it's at that point, it's like Coinbase, where it's going to be dependent on what crypto is doing. And at that point, I'm like, why would I trade a trading vehicle that's going to be dependent on what crypto is doing when I can just trade the cryptos instead? And I know Square has a very sound business outside of just its crypto side, but to me, any company like getting that extra exposure to crypto right now just has more maybe risk involved than companies that don't. And I still think, I've made this point before on the show too, like Apple, right? Let's go to our financials tab with Apple. Apple has on its balance sheet so much. Apple has, look, $28 billion that it's just sitting on. Wait, let me make sure that's right. No, $280 billion. Yeah, Apple has more than $200 billion that's chilling. It's like $250 billion that Apple is just chilling on with cash. Apple is the biggest technology company in the world. To me, there's a reason that Apple looked at the crypto industry and said, yeah, not for us. Like you don't think that the biggest technology company in the world with the most cash on hand, the most ability to like make these types of investments, said that they're not going to get into crypto. I think that's a sign showing that like some of these companies that have gotten themselves exposed to crypto have gotten hit because of it. I mean, Tesla bought a bunch of Bitcoin and then sold it. I think Square is an example of a company that's in the crypto space, but is not all reliant on crypto, but now just has that exposure as well. I think it's interesting. I'm curious. Tim Quast will be joining us in a few minutes. I'm curious to look at some of the supply and demand for some of these crypto stocks like Coinbase, like your miners, your Maras, because I'd imagine that the demand is just on the floor right now for them. Because for most companies, a lot of times we have to wait every 3 months to when they report earnings to get an idea like of what's going on with the company into the revenue. But with crypto trading, we can see it in real time. Everything's on the Ether, on the blockchain, on the Ether scan. Like we can see how much crypto is being traded. And a lot of people are speculating that, a lot of the crypto being traded on a daily basis is essentially being traded just between some of these players, and even that it's even more inflated than what the numbers look like. And they're down a lot because you don't have a lot right now with Bitcoin below $30,000. And even when Bitcoin's above $30,000, when it's just hanging out like this is a daily chart of Bitcoin here. When it's just hanging out like this, barcoding, like that is not enough to get retail investors, new investors in, people talking about it, people excited about Bitcoin, and for Coinbase to get new users and new customers. It's not enough that it's just hanging out at its levels and not going down. It has to be going up. Otherwise, you know, that's when you get, right, let me zoom out on the daily chart here. When we were at, you know, 65,000, this is right when the most people are talking about it. This is when Coinbase is getting more users, new users every day, because people are hearing about, oh, so-and-so, you know, my cousin's friend made, you know, $60,000 on Bitcoin. I got to get into this. That's when they're hearing about these stories, when it's up here, not when it's just hanging around $30,000 and trading sideways. So I can't imagine any of these crypto companies are really doing well right now by any metrics. So, oh, and Spacman in the chat saying Bill Gates stayed away as well. To me, like that's just that's a sign to me that they had an opportunity, right? Apple could have bought Coinbase 5 years ago if they wanted to. They probably still could have bought Coinbase a year ago if they wanted to. They didn't. They don't. Apple could have made it to where everyone can buy and trade Bitcoin straight off their iPhone. They didn't. Apple has Apple Pay. That's why they don't like crypto. But what I'm saying is if they really looked at this, whenever they looked at it 10 years ago, 5 years ago, whenever they looked at crypto, if they thought, okay, this has the potential for us to be like a great business, they would have done it. Kyler's saying next Friday should be fun with the OPEX after FOMC. Yeah, I mean, the FOMC... or I mean, the OPEX is set to be one of like the biggest OPEXs like ever. But we talked about this with shoot, I forget who, one of our other guests. But if you Google like that phrase, it's happened like 10 other times before, where people are freaking out about how much money is going to go into this OPEX. I think I saw some crazy percentage that for like next Fridays, it's going to be more than 5% of the total U.S. equity market, like the billions of dollars that are set to expire. Yeah, Faults. I've been seeing that too. I would be so Bill Gates. I was fact checking this the other day because I've been seeing a lot of like conspiracy theories out there about food processing plants like burning down and Bill Gates buying up all the farmland. I think so. When I fact checked this, Bill Gates is the largest private like landowner of farmland, but when you look at how much he actually owns, it like comes out to like literally less than 0.2%. So like acting like Bill Gates has, again, still the largest landowner, but saying like, I don't know. I was just seeing some conspiracies that he was like out there like owning like half the farmland out there. No, not true. If you look at how much farmland he actually owns compared to how much farmland we have, it's a very marginal kind of nominal amount. Still, I mean, interesting. I think that's showing that that Bill Gates is looking around this wide, all these opportunities, this myriad of opportunities. He has billions and billions of dollars, can invest in anything, and he's choosing to invest at least some of his money in farmland. I also don't think it's like a huge portion of his investments. I think it's like that's his like diversified portfolios. He has these investments in all these other places, and then has like a little bit of money into farmland as part of a diversified portfolio. But yeah. All right, well, we do have Tim Quast hanging out here in the background. It's a little early, but I think we have a lot to talk about. So if he's ready, we'll go ahead and bring Mr. Quast on. Let's give him our special intro and check out what's going on in the supply and demand world. Mr. Quast, how you doing this Friday?
Very well. Thank you, AB. How about yourself? Good to see you.
I'm good. As you can see, I'm just going through the show solo now without Spencer. So I'm trying to survive.
I feel for you. It's tough flying without a wingman. It's tough being the new Spencer.
I know. It's like I'm like Maverick that lost my goose.
You have lost your goose. I'm sorry. I hope that there's a hunt underway for a new goose. A new
We'll
golden
see.
goose.
Yeah,
Yeah.
we'll see. I might just be taking on Maverick and Goose responsibilities
You,
from here on out. But
you
yeah, I
might
mean,
just be Top Gun. Yeah.
it's helpful when I have people like yourself that I can invite on the show that know more than I do, because it makes my job a lot easier.
Well, it's only because I'm older than you, AB. That's it.
Well, yeah, I mean, in all my years of learning, that's like the one thing that I have learned, and I know for sure, is that I don't know a lot of things, and I have a lot more to learn. I think that's
It's a good attitude. Yeah.
yeah.
Always be open to learning. Yep.
I love it. So do you want to get your screen shared, and maybe we can go through some stocks on MarketStructureEdge, kind of see,
Sure. Yep.
maybe some of that supply and demand. I don't know if I'm sure you have thoughts on what's going on in the market today after our CPI print this morning, as well as, I was mentioning the OPEX coming up next Friday. So I'm sure we'll get to all of that.
What's OPEX? Tell me what OPEX is. That's operating expenses to me. To investor relations officer. That's what it is.
Sorry, it is options expiration. So essentially,
options expirations. Oh yeah. Okay, that I know. That's a core part of what we talk about all the time. Yep.
Yeah. So there's been a lot of kind of news stories over the last couple of weeks about how next Friday's options expiration right now is set to be one of like the biggest in equities history, where it's like I mentioned earlier, the last numbers I was seeing was that whatever the billions of dollars amount is equates to, it might even be trillion, I don't even know, but it equates to more, however many trillions of dollars are set to expire next Friday equates to like more than 5% of the total U.S. equities market, which is kind of mind-boggling to think about. But then the flip side to that is, you have people kind of freaking out about it, and then you have other people saying, yeah, this has happened like 10 times before. Here are all the news stories about how bad this was going to be, and then nothing ever really happened.
Well, the reason this will be bigger, and volatility always affects these things and sort of compounds them, is because it's the second quad witching. And how much of the quad really exists? That means that there are options and futures on indexes and stocks both expiring. Therefore, 1, 2, 3, 4. There's your quad. There aren't a lot of single stock futures contracts, but there are a lot of non-standard ones. That is, that you could buy. If you're a big, hedge fund, big institutional investor, hard for us retail folks to do this. Most of us don't have prime brokers. But if you do, then you're a big trader. But there are a lot of those. So that's why it's big. In the data, which we have studied for a very long time, 17 years ago, more than 17 years ago now, I started a quantitative market structure firm serving big public companies that is the largest provider today of quant data to U.S. listed companies. And a core part of what we teach folks is don't report results during options expiration. So we've had a long time to see how those things have compounded. What we find is that March is the biggest. There's March, June, September, December, but there are options expirations every month. And in fact, traders, you could use this calendar too. If you wanted to go to Modern IR.
Uh-oh. Looks like Tim might have accidentally just closed out his window, so we're going to give Tim a few minutes to come on back in the show. Until then, let's pull my Benzinga Pro back up. I'm still watching the S&P 500. We are on the 2-minute chart here. 2-minute candies. As you can see, we gave up some of those gains from when we were having a nice little bounce. And then now we're just kind of hanging out at this level. Looks like this 390 level is kind of going to be where we're trading at till we get a break either way. I mean, your guess is as good as mine, guys. I have no clue. I wouldn't be surprised if we end the day down another % from here. I wouldn't be surprised if we rally and I think I said earlier, like if I had gun to my head, if I had to give a prediction, I would say I think we gain a little bit back from here before closing today, but not enough to like go green or anything. I mean, I think like the S&P could easily finish down finished down like 1.5% today, as opposed to 2.5 or 2.75. I think that's reasonable, but yeah, I mean, yeah, Kyler's talking about it's just so tough because on some areas, and we talked about this too when I was previewing CPI. We knew what was going to drive the CPI higher, and I have some of those numbers. Yeah, I agree, Stacks. There's no way we're going to go green. Sorry, let me. So we knew what was going to drive CPI higher, right? Gas prices. Gas prices have been rising. We haven't gotten any relief there pretty much at all. Fuel. So in May, fuel oil, 16.9%. That is a huge increase. And the problem with that is that the price of oil and fuel oil coming out higher causes other commodity prices to go, right? If you grow and sell oranges to grocery stores, if that's what you do, if you're a farmer that grows oranges and you sell them to grocery stores, now to get those oranges to the grocery stores is more expensive because the oil's higher. So oil's up 17%. That's a problem for the rest of the economy, right? Airline fares. This is literally like so the biggest increases are fuel and oil. I literally said on the show I think a week ago, like we know gas and air prices are going to be higher. The question is, have there been enough price cuts in other areas to kind of offset that? I personally thought so, because if you walk around like CVS or Target right now, there's like a lot of shit they have to put on sale, and we talked about this yesterday with Target announcing that a lot of computers, TVs, things like that are now going to be cut at Target by as much as 90%. So we are going to see prices coming down on some of these goods that don't have that high demand anymore. It's just going to be, is it enough to cut down on some of these other things? So your biggest increases, fuel oil 16.9%, airline fares 12.6%, public transportation 8.6%. And that kind of tracks because, I mean, some public transportation, subways and trains shouldn't really increase, but for like bus fares and stuff, if they have to pay more money for the gas, maybe the fares are going to go up a little bit. And then your median increases, so this is just kind of what increased by about 0.5%, so kind of more moderate inflation here, but still inflation. White bread, fruits and vegetables, sugar and sweets, butter, dishes and flatware, tools, hardware and supplies, women's and girls' apparel, shelter, dental services, and outpatient hospital services. So those were all kind of contributing to inflation, but not really driving it to that 8.5% level. That was mostly fuel and airline fares. And then your biggest decrease, smartphones down 5%. Clocks, lamps, and decorator items down 3.7%, and televisions down 3%. So it sounds like, just looking at the goods that have decreased in price, smartphones, clocks, lamps, and decorator items, and televisions, what do you have in common? They're all things people are buying for houses. So whether that's people buying new things, sure. It's also, are less houses being built? Maybe. I'm not sure. Either way, I think we're going to continue to see some of these prices coming down. Something that and again, this is like all anecdotal. I don't really know if there's a good way to check on just prices of average flights, but I was on Google Flights looking to fly. So I have to go back home to St. Louis later this summer. And I was looking for this weekend right here, July 7th through the 10th, round trip show flights. Let's check. Okay. Wow. So I literally, let me check. It was showing, it did have on Google Flights where it would show like price graph. Here we go. So now it's about, oh no, this is showing for the actual dates. before it was showing kind of the trends of the prices. But wait, now we're looking at completely different dates. So either way, bottom line, and again, this is anecdotally, I was looking at these flights like a week ago, and they were like the prices they're giving me right now, like $435 for this round trip from Detroit to St. Louis. And I was like, all right, screw it. Like, I guess we're going to drive. And then I checked again yesterday because I got an email from Southwest saying like, oh, $50 flights on Southwest, whatever. And I checked and I booked a flight on Southwest for like $200 round trip. So I was like thinking maybe, oh, wow, maybe this is finally airfares coming down. But it looks like that might not be the case. Maybe I just got lucky. So I'm going to, for Monday's show, I'm going to gather some data over the weekend just about flight prices to see, are they continuing to rise at the rate they have been? Have we seen the prices kind of stagnate, or have we seen them fall? But all right, I got Mr. Tim Quast back. Let's go ahead and bring him on. Mr. Quast.
Well, I must have excised myself from the show. I don't even know where it happened, but I was unaware for a period.
Oh, you were still talking, and you were talking, and you weren't here.
Yeah. Then I realized that I was my only audience, which may have been time well spent. Anyway, I don't know exactly where we were. I can summarize the key things. You know what I somewhere.
Yeah,
in there,
let's do that because I don't.
Yeah, so I was talking about options expirations, and I think we covered that. You can get that calendar off of the Modern IR website. It's very handy, great way to see everything that's going on. Not just that it happens on a Friday, but there are 3 expiration dates every month. And in this particular month, there are also all the Russell rebalances. There are some MSCI rebalances. There are all kinds of things going on, and volatility makes those things more challenging. Then, my broad view is, and we were, I don't know, somewhere in this process we got disconnected. But I was saying that we were pointing out for Edge users all week how we had reached what we look at supply and demand, and you mentioned that as a setup, AB, but that's key to what we do. We're going to look at broad market supply and demand portfolio. We can talk about crypto stocks, what the supply demand equation is. But this is the thing that this is our risk management tool for Edge users. We will look at broadly an algorithm that is demand for the 500 stocks comprising the S&P 500. That's the green part of the chart. The purple part is SPY. It's a proxy for the broad market. And when demand rises above the red line, we know that the probability of additional gains begins to diminish. That's 6.0. And so currently, sentiment in the broad market as of yesterday is 7.6. It has ticked down. It's beginning to fall. But at that read, the probability mathematically of additional gains, no matter what occurs, good news, bad news, indifferent news, war, inflation, Fed policy, doesn't matter. The probability that the stock market continues to rise diminishes to 0. Actually, above 6.7, the market shows a propensity over the last 18 months to decline 5%. And so, if you know that going in, back here on June 3rd, we topped 6. By June 6th, we're all the same as 7. By June 7, we're at 7.4. Well, there's a mathematical probability of declines. Why would you leave your money in? And then if you look at the supply side of the equation, supply and demand, there's a supply chain in the stock market, as there is in any market, and it's short volume, that when it soars, so if demand stalls and supply continues to rise, it's almost half of all trading volume is borrowed or created. This is not short interest, folks. Short interest is not a meaningful measure. It's a 1974 measure that has never been revised. Short volume is a 2009 measure that measures the amount of trading coming from borrowed or manufactured stock. Market makers can create shares. So when that happens, the likelihood that the market continues to rise is 0. The probability that it drops sharply is significant, and son of a gun, it did. So it has nothing to do with people's surprise at something. It has to do with supply and demand and the behaviors in the market that create those. And that is principally very short-term trading. That's what's occurring. So then we could talk about individual securities, AB, if you'd like.
Yeah, I saw someone in the chat asking if you had data on some Chinese names to see some sentiment. I mean, I would think like looking at Baba or something would probably give us
Yeah.
a good idea of how sentiment is looking like for Chinese names right now.
Yeah, if they're U.S. listed stocks, we will have data generally. So here's Baba, and it's so you could see what has happened when demand and supply diverged. So supply is below the trend and dipped down, and demand surging. The probability of gains is very high when those conditions reverse. And see, demand is still strong, but supply now it's over 60% of the trading volume. Over 2/3 of the volume in Baba is coming from stock that does not exist. It's borrowed or created by market makers. Well, if demand falters at all, that's going to cause the stock to drop sharply, and sure enough, it did. Yeah, it's hard to get the perfect day, but you know that if the trend in the supply side is rising and the price jumps up, and you're holding this stock and it goes way up, look, just take the gains. The math is telling you now that it's unsustainable, particularly when you look at the broad sentiment in the market at already at that time 7.7. We have only been there a couple of times in the past 2 years that high. And so that's how you would look at it.
Got it. And then do you have any, is there any way to know, or not to know, but to anticipate if these demand trends are going to continue or if they're going to drop, or is it all kind of lagging indicators?
No, well, it's very predictive. It's not a lagging indicator. We know that that when demand and supply diverge, go opposite each other, the probability of gains is very high. We point this out all the time. Things that I traded last week. So yes. How do you know when to buy something and when to sell it? That's the greatest question of all, right? So one of my great trades here recently, which we pointed out to edge users, and we have math running all the time to tell us about these things. So if you have divergent, see this demand is shooting up, and supply is pretty high, but then it tips down. So diverging supply and demand are very good. And when it dipped even further, that's where I bought it right there. That's awesome. But once supply, there's your exit. Doesn't matter if demand is still 10 out of 10, slamming into the ceiling, but the supply side rises, get out. Take your gains. Who cares whether it goes up a little bit more after that? Be happy. And sure enough, it was a very good time to be out. So that's how you know when either of these two sides of the supply demand equation, the teeter-totter, let's call it, changes. There's your exit. When they diverge, entry. When they converge, exit. Or if one of them moves. That's how to do it. Is it perfect? No, but it's a very, very high probability way to have success, to successfully trade any condition. And I point this out. Here's what we tell edge users. We have two core portfolios that the math generates for us. Big and stable. This is the stuff that you want to trade when conditions are challenging. If it's going to be volatile, be in things that are not volatile, because that's where everybody will go. It will become a crowded trade, but that's to your advantage. There are only 5 in it. When that's 20, that's where everything is. And then when the market is a momentum market, then trade momentum. And that's also very measurable. Last week there were 15 of these. Now there are only 3. Well, there you go. 5 in one, 3 in the other. There's no good trade. That's what it's telling you. Well, when there's no good trade, just take your money out of the market. And then when the math tells you, oh, the numbers of big and stable are increasing, well, then we can go back to that. The only thing I could point out to folks today, actually yesterday, was BDX, Becton Dickinson. I could say, well, there's a stock, if things are troublesome, might do okay. And it's only because demand is steady at 5 and supply has fallen. Well, you can look at it today. It's certainly outperforming the market. Nothing's doing great. I mean, there are outliers here and there. But that's how you would use the math. You want to be in things that will give you an advantage, and that's how we think about it. Now, do we want to look at some like cryptos? Let's go look at that. So I have a cryptocurrency portfolio. I just created it, and mine has a dozen stocks in it here that most of them are in the tech sector. Fast trading, high frequency traders who don't want to own anything are the lead behavior. Look at the supply demand trend in that group. If we take those 12 stocks, demand is falling and supply is rising. Well, the probability is the prices decline. Hey, if you short, that's a good short. You can short until those conditions reverse, then you go long. Coinbase, I heard you mention Coinbase. Let's look at Coinbase. So here's Coinbase. By the way, these are important. It's like 65% of Coinbase is short.
Wow.
Yeah, that's 8% volatile every day. By the way, that's a great trade. If demand in Coinbase is rising and it goes down 6% in a day, very good trade. I mean, the likelihood if it moves 8% in a day, that in the next 2 days you get a gain if you bought it when it's down 6%, is a number approaching 100. I'm not saying that it's a 100% guarantee, but it's a high probability. Currently, supply is rising and demand is falling. Not a good trade. And you can see fast traders know that, and they're pushing it in the direction of pressure. Trades $4,800 at a time. Beware. Don't try to buy $10,000 of it at a time. You will move the market. That's why you have to trade in small increments. But let's look at the supply demand equation, and you can see this right away, that here's the trouble. Supply is rising, demand's falling. Price will do exactly what is predicted out of that.
Yeah, I mean, it's incredible how simple you are able to break this down and make it, to anyone who understands basically basic economics, thinking about this in terms of supply and demand makes it a lot more understandable. And it also helps explain why, when you have some of this divergence in valuations of companies, and it's like, oh my God, Tesla's trading at this valuation. It's like looking at this, it doesn't matter. Is demand rising and supply falling?
Exactly. That would be true. We would be concerned about the multiple assigned to a stock if 80% of the money in the market were motivated by looking at multiples, but it's the exact opposite. In fact, it's even worse than that. Only 10% of market volume is motivated by earnings multiples, or multiples of revenue, or multiples of discounted cash flow, or whatever your multiple is. 90% of it isn't doing that. Passive money doesn't run multiples. Passive money says, this much money has flowed into my fund, and my fund invests in the S&P 500. So I deploy it in the S&P 500, period. That's a model. High frequency traders do not care what multiples are. They care about the spreads between bids and offers. That's all they care about. That's all they trade in an investment horizon of a day or less, and they're 54% of market volume. And then about 18% ties to derivatives. Can I buy the options on this, and will they go up 20% and then I can sell them to somebody else? Or can I buy puts in the belief that the stock's going to go down and then I'll exercise it? That is 18% of the market. That's not dependent on earnings multiples. It's dependent on prices. So you have to beware of all those things, folks. That's how the market works. And it's essential to doing well in it, understanding how it works.
Definitely. Antisocial in the chat wants you to check Amazon.
Antisocial. Thanks for being social today. Good to see you.
Yeah.
Let's take a look.
Getting out of their shell.
Yeah, you're right. And asking a question. That's not very antisocial.
Yeah.
So good for you. So it's not horrible. Amazon's not horrible. Would I buy it at this point? I like to buy rising demand. This was a good time to buy. Although the supply side, when it's over 50, if I were looking around, all things being equal, I don't like to buy stocks that have more than half of their volume that is artificial, that's coming from borrowed or created stock. Again, it's hard to wrap your mind around that, but it's a fact. So I'd look at this and say, Amazon is likely to hold up a little better than the rest because supply is right at trend, but still, it's 59% of Amazon. And think of how it's one of the most liquid stocks in the market. It's the most liquid stock in the market by dollars per trade. The only thing more liquid is SPY. But while the demand side is pretty good, the supply side is very high. So if demand diminishes at all, that's going to weigh on price, as you see the last 2-3 days. So it's not terrible, but it's sure not where you would buy it. When would you buy this stock? Well, when supply is well below the trend and demand rises, that's where you could buy the stock and benefit from it. Once demand begins to fall and supply jumps over trend, well, then leave. Take your gains, and we'll go find something else that works. That's the way to do it.
And then thank you for running through Amazon. Caleb wants to look at Unity. Ticker U.
Caleb, how you doing? I have to remember what Unity's. That's UNIT, isn't it? Yep. Okay.
No, it's just ticker U.
Ticker U. Here it
All
is.
the way
I
down.
forget.
Yep.
Yeah. Okay. Got it. Okay. Always have a. It's too bad they're both named Unity. One I, one Y. So here's where Unity was awesome. Like here was the spot when demand's rising and then supply all of a sudden drops. Okay, there I'd buy that, and I might as soon as the supply side jumps way over trend like that, if you have gains in the stock and you can see supply is now look, it's 70% of the trading volume. 7 of every 10 trades are artificial stock. Well, take the money. But there, once again, the math are very clear when you could buy that thing and when you should leave it. Just use supply and demand. Very simple stuff. Thanks, Caleb.
Yeah. Caleb, let us know if that answers your question. Let me see. I'm just going through the chat real quick to see if anyone's got any other tickers they want to check out. Oh, Super Spacman's good idea. He said perhaps Shopify due to the split coming up, because it looked like on Amazon's chart maybe we saw that demand rising because of that split, but I don't know.
It can happen. That's a weedy element of market structure. Okay, so here this is price, and we're only taking closing price. We just want to, because we're not trading price. We're trading supply and demand. Price fools you. And you want to look at how much shop moves every day. We track that volatility in the portfolio view. At the moment, I mean, it's not terrible, right? So supply is still too high for my comfort. 55% of trading volume, 54.6 there, is manufactured or borrowed. Demand has been pretty good, but is beginning to come down. You'd say, well, Tim, this is below trend. Yes, it is. It is below trend. That's a plus. But it's still too high for my comfort. I don't like those levels. So is it terrible? No, it's not terrible. The weedy element that I'd mentioned here is when you see a big jump here in supply ahead of a big surge, that can be the creation of stock to fill large orders. It's a little known fact for everybody listening. Almost all large orders for stock today are filled using manufactured stock because it's just not around. The stock market is a grocery store, but it doesn't have a whole bunch of stuff on the shelves. It just has a little bit. So if I'm Fidelity and I walk in and say I want $1 billion of Shopify, broker dealers are going to manufacture $1 billion to fill my trade. So then we're going to see that in a big surge on the supply side, which could hurt price, which it did. Right, so it does. But we know what's occurring then. That will work its way out. So this has worked its way out right here. That's what's happening. That excess supply has now been removed from the market, which is good. But it distorts the price. I look at this whole supply and demand equation here, and the amount of time that Shopify is spending above 5, which is almost none. It's spending almost all of its time below 5. I'm going to go trade something else, right? I'm going to go trade stocks in energy. If you look at Valero, something like that. Go where the money is. Go trade there, and don't trade on hope. Look at Valero. It spends all of its time above 5, always above 5. Right now is not a good time. Supply side has jumped way up to 60%. Get out. Take the money. Wait for those conditions to change. But buy stuff that spends a lot of time above 5.
And then I'm curious if do you think that's across the board with some of these energy companies? Like if we looked at Chevron, would that supply be increasing? Because that would make sense that as like you're saying, that this artificial supply, as the demand stays elevated, that more supply will be created to match that demand.
Right.
Yeah.
No, you're absolutely right. Then it will have to even out. It will. There's always it's an important economic principle and a basic one that when supply increases, it will be a drag on price, no matter what, even with high demand. So Chevron, spends almost all of its time above 5 too. So once again, if you were going to buy Chevron, the time to do that would have been in May when demand was rising and supply was falling back to trend. That's a pretty good time. And then you could stay all the way till now. Now demand is falling and supply is above trend. Take the money. But it's not more complicated than that, folks.
Right. So it's essentially you want to buy while this divergence is forming and not while that equilibrium is being found.
Exactly. Yeah. Once equilibrium is found, say that 3 times.
There's no
fast,
trade.
There's no trade. There's no additional meaningful return, and go find another one. Exactly.
So I'm trying to think of a sector. I'm trying to think of where maybe somewhere that would have falling supply right now. Is there anywhere? I mean, I think we looked at one stock earlier that had some falling supply, but
well, the logical thing would be you would say, well, in a rising interest rate environment, wouldn't that benefit financials? Well, let's go look at financials. We put those on the Edge platform. So you will have all 11 sectors plus the FANGs. So financials have 509 components. Passive money is the lead behavior. Here's the equation. It's not great. I mean, it's been above 5 since mid-May, above 5 with supply trending down. The exact opposite of a lot of the things that we've looked at. But even now in the financials, demand is beginning to wane and supply has jumped above trend up to 50% of volume. So once again, it's not a great time. So for that may be leading into options expirations next week, where a lot of bets have to get sorted out, and that's going to interfere with performance. So I'd still prefer to see those things go the other way. But that's, compare that to the FANGs. The FANGs have actually had a pretty good little period here, but supply, the demand side is falling, and supply is on an uptrend and is at, in the whole group. So we have 11 stocks in there, 55% short. Very difficult for it to rise. I mean, pick a thing. You could say EV. EV has downtrending supply, but demand has peaked and is falling. Even energy, which has been awesome, the whole group, 139 stocks. Demand is still way over 5, but it's tailing off. Supply is tailing off too. So energy is going to perform the best. But even it is not going to have the momentum that we've been able to trade the last month.
Yeah, so I've been watching that too. Like, you would think, like, I'm looking at the XLF right now, and you would think that with all this, that it'd be doing well, and it's down 3.5% today. So I guess, Tim, you'll just have to keep us apprised of everything going on. Let us know if you start seeing something in industry in particular that has, falling supply and demand rising. Let us know, because I wanna be able to use this for my own gain.
Absolutely. Look, I buy the stuff that we point out. That's the stuff I trade. I mean, I'm just following the math. The energy is down today because of this. The dollar is up almost a full percentage point, and oil is denominated in dollars, not the other way around. So the denominator gets larger, the numerator gets smaller, which is the price of oil. Right? It's pretty simple.
Looks like we're getting your audio is
I'm gonna just hit my mic.
For some reason, right when you like went to that website, right when you went to Market, well, maybe it's because they're a Benzinga competitor, but right when you went to there, your audio started cutting out. But I'm sharing the link to MarketStructureEdge in the chat. You will be able to. I think we have a promo code you can use to try it out, or no, free 2-week trial on MarketStructureEdge, and be able to get some of this.
Name and email.
No credit card needed, nothing like that. Be able to get some of that good supply and demand information straight from the site, and you can be able to implement it in your own trading like I am also trying to do. Tim, I always appreciate you coming on. I hope you have a great rest of your Friday. Have a great weekend. You're hanging out in Steamboat, it looks like?
I am, and it's fabulous. River's running high, beautiful weather, and everybody's happy. You enjoy your weekend too. Good to see you, Aaron.
Hell yeah. Love it. Always good to see you, Tim. All right, y'all. Tim Quast from MarketStructureEdge. Go sign up for that free 2-week trial. You guys see how much good information Tim has, and information that can truly allow you to trade a little bit better, understand the markets better. I know I need to do a better job of that when I'm looking at a stock to buy, to see the actual supply and demand, because like we talked about with Tim, you can talk about the valuations all you want. The majority of people out there investing, whether you're talking about institutional investors, whether you're talking about retail investors, don't care about those valuations. They care about, is the price going to go up? And what drives that price going up or down is that supply and demand. So to me, it's really cool to see someone like Tim build that platform that really breaks things down to that simplest, economic principle of supply and demand. And I'm of the theory, it's Occam's razor, just basically that, like, the simplest solution is always the best. You can do all these different trading strategies you want. If you're able to understand the supply and demand of stocks, then you're going to be better off than basically being able to understand anything else. All right, real quick, guys, because we only have a few minutes left. Let's go through another quick rundown of the market. We are not doing anything really. Hold on, I gotta get back logged into my Benzinga Pro. We're not doing anything exciting out there right now. It doesn't look like in the stock market world. Looks like we're just kind of chilling. Kind of chilling down here in the SPY down SPY. We are down 2.78%. We're looking at the 2-minute chart here, so you can see we got this little rally, gave it all up, rallied again, giving it up again. So I would just be watching. If you guys are day trading the SPY right now, just watch this low of day. Looks like 389.87. So, hanging out down here, not exciting. Looks like we're just kind of trading in this range right here from about 390 up to 392. If we get a break either direction, look for a bigger move, either to the downside or if we get above that 392 level, but nothing really going on there. Let's check in on the Qs, down 3.5%, pretty much same chart there. Tesla now down more than 4%. Oof, below that 690 level. So, pretty tough out there. Again, we were talking about DocuSign earlier. DocuSign gave that shitty earnings report, down 23%. Boy, am I glad I got out of this one. I really liked this one a few months ago because of just how far it was trading off. Let's go out to the daily chart. How far off it was trading from its like pre-COVID levels. I mean, pre-COVID, we were at $91, and it's like, all right, this thing got an obvious boost during COVID. People were using DocuSign more during COVID than before, and they were making a lot more money. The stock's down. Let's check in on Redbox again. I mean, guys, I'm telling you, if you want the Fed to not keep hiking rates, we can't keep having these fucking shitty companies up 35% in a day. That's just gonna make Jerome Powell is gonna see this. He's gonna see. Yeah, Andy, you did tell me that. I got out of DocuSign. I bought some and I got out of it. Like, it's fine. I lost a few bucks. Like, not a big deal. I'm gonna be wrong if I'm gonna be in this industry for a while. If I'm gonna be picking stocks for a while. If I'm gonna be trading and investing for a while, I'm gonna have some that I'm wrong on. I was wrong on DocuSign for sure. Redbox, like I said, hey, we gotta cut this out. You got to nip this in the bud. Otherwise, Jerome Powell is going to see this and say, you know what, we're going full percentage point next time, because this is just blasphemy. This is just craziness. It's literally a 60-cent. This company is getting bought out at 60 cents a share. It's trading at $12. It's Redbox. Why is anyone buying Redbox stock right now? People aren't even buying Netflix stock, let alone Redbox stock. But all right, guys, this will be the end of the show today. We are going to test out a kind of a new schedule where we run Benzinga Live from 11:30 to 1, so for 90 minutes a day, as opposed to 2.5 hours, just with Spencer out. So, guys, pleasure hanging out with you this week. Thanks for hanging out, getting me through the first week without Spencer. We will have some kind of new show segments going forward. It'll look a little bit different, but I'm really excited about these changes. And I hope everyone has a great rest of your Friday, great weekend. Stay green. Love you guys.